Financial Argument. Follow us on YouTube.
Well, thanks, Dave, for having me back.
Hey, thanks for being back here. And let's start off with how the economy is doing, what the labor market is doing here in the United States and around the globe. I know you've written a couple of articles about the labor market, and the U.S. government, they're continually telling us that the labor market's improving, it's getting better. When you look at the labor market, what does it look like to you? Is it improving? Is it getting worse? What's your thoughts on that?
Two things that I'm thinking about right up front when I look at the labor market in the U.S. One is it's improving for some people. That's clear. Some people are doing really well in this labor market, but other people are not. And so it's really not improving for them. It's deteriorating for them. At the lower pay scales, things are really bad. I mean, the median wages have been claimed recently to have risen a little bit, adjusted for inflation, but that's only because of the upper end of the wage scales have risen by a lot. So you're talking about people that are already doing really well, getting big pay increases, including CEOs and top executives. But on the lower end, it's just not happening. And so people who have jobs, the lucky ones at the lower end, they don't see the pay go up to keep up with inflation. So that is part of the issue, that for 80% or 70% of the employees out there, this labor market is really tough. The other part is that the U.S. economy has created about 14 million jobs since the bottom of the financial crisis. And that's a lot of jobs, you would think, but about 15 million people moved into the labor force over that time. So now we have, on a per capita basis, we have fewer jobs than, or about the same, really, as we had at the bottom of the financial crisis, at the worst jobs fiasco we've had. So this is what people are feeling. You're getting the pie is growing, and the employment pie is getting larger, and that's what the labor reports are telling us. What individuals are feeling is that the slices are getting smaller, and because there are more slices, the pie has to be cut into more slices. And so, then on an individual basis, on a per capita basis, the labor market is not doing well at all.
So when we look at the labor market and they continually tell us that, everyone is getting a job, the companies can't find people to work, is this true where these companies are finding it difficult to find people? Because when I look at what's happening around the world, I see many corporations laying off. I mean, if we look at Challenger Gray and Christmas, they're telling us that layoffs are increasing, not decreasing. So it's kind of confusing in what they're saying.
Yeah, that's a common complaint, and you can hear that in almost every economic period, that it's hard to find the right people. And that's if you ever run a business, that is one of the key issues every hiring manager faces. Finding the right person is one of the most difficult things to do. And yet the higher your standards are, and the more picky you get in your criteria, the more difficult it is to fill those positions. So if you now online, you post all these job ads online, and it doesn't matter how many words you put in your ad, so you put all these requirements in it, and there's 4 pages of requirements that nobody can fill, and you really don't need that new employee to be able to fill all those requirements. And so now, since it's all done by computers and algorithms, and the algorithm doesn't spit out anything, you say, well, these people are hard to find. But if you change the requirements a little bit and loosen them up and allow people, granted people a learning curve, suddenly you would have tons of people standing in line for these jobs. And so I think part of that complaint has to do with how hiring is done today. It's always been difficult finding the right people, but with algorithms running the show today, you put in the requirements that's just a little bit too tight, and you're not going to get any applicants coming out the other end.
Yeah, because when I look around, I see like the requirements for positions, and they list everything under the sun, that you need to do everything, not just one particular task anymore.
Right, and that's there's some people out there that have confirmed that by saying, look, I copy and paste the requirements into essentially invisible text into my application, into my resume, so you can't really see it, but the algorithms pick that up and they get the calls.
Wow.
It works, I mean, this is how this works. Yeah, these incredibly long, as you said, everything under the sun requirements, they're self-defeating, I think.
When we look at the economy as a whole, do you see any signs that the economy is slowing?
That's hard to say because it's already been slow. I mean, so how much slower is it going to get? It's been growing, but it's been growing in some ends and it's not been growing in other ends. So on average, it's been growing very slowly. And we have seen manufacturing already in a decline. It's been 2 years now, probably. When manufacturing goes down, the transportation sector goes down. So we've seen that. Services have held up. Now, services includes healthcare, and healthcare is now 18% of GDP in the United States. It goes up because it gets more expensive, not because people are buying more healthcare. So that's the wrong reason for and healthcare is sort of cannibalistic. It's not really producing anything. So when your insurance rates go up, that contributes to GDP, but it's not really helping the country, in any significant way. It's making the insurance company richer, but that's about it. So in the services sector, we have the biggest element there is healthcare, and healthcare is doing really well, for the wrong reasons. So, if you take, and auto sales actually have been doing well too. So those are the two really strong elements in the economy. Auto sales have tapered off now, so we're losing that. Had a record year last year. This year, they're talking about the car recession. The manufacturers are talking about the car recession. We've had a decline in sales in September. For the year, they're about flat. So auto sales are not growing anymore. So the only thing that's really holding up the economy right now is a big force is healthcare, and that's the wrong force to hold up the economy. Healthcare as a percent of GDP should go down. We should try to control this monster somehow.
Let me just get this straight. So with healthcare, as the premiums rise, it helps the GDP.
Right.
Okay. Now,
as far as pharmaceutical prices shoot up, as we've seen, the triple prices for these products. I mean, you have the higher dollar transactions, or that slightly change the use of a prescription drug, and then suddenly extend the patent protections it has, and instead of getting generics on the market to compete, you have to buy. I mean, all these things. When prices are high on these, and when new products come out with even higher prices that get pushed to replace the cheaper products, all that is positive for GDP. It's not positive for the economy. It's positive for GDP. And so GDP is a bad measure, but that's what everybody looks at right now.
So you said auto sales are slowing down now. What is the reason for that? Why were they doing well, and then all of a sudden they're starting to flatten and starting to slow?
Auto sales are always cyclical. So you have many years of increasing auto sales, and then the market gets a little saturated, and auto sales are always pushed by cheap credit. So you extend the loan terms, you increase the loan-to-value ratio, so when you can borrow more money on your vehicle than the vehicle is worth, and now they have car loans that are up to 8 years, and so you really, a lot of subprime borrowers are getting big loans with loan-to-value ratios of 120%, and so you have finance companies that are barreling into this, and they're trying to push the loans, and they securitize those loans, and so we have subprime-backed auto loan securities. And these things push auto sales. Free money or cheap money pushes up auto sales. Now, we've seen on the subprime side, the defaults are now soaring. Some of those auto loan-backed securities are getting in trouble, especially the ones that are backed by subprime auto loans. So the credit is tightening a little bit on that side. Consumers are strapped, and so we've now seen this sort of reach the end of how far credit bonanza can be pushed, and so auto sales are going to take a hit. This is not plateauing. I think we're seeing a turnaround, and they're going to decline.
You mentioned GDP before, about health insurance, about premiums, auto sales. And we continually see the Atlanta Fed, they come out with their GDP numbers. Oh, this year it's going to be 3.5%. Then they revise them down. They revise them down again. First of all, what is the reason for starting out so high and then just revising them down to 1%? Why do they do that?
But the Atlanta Fed has a GDP model that tries to estimate the first estimate of the Bureau of Economic Analysis's GDP number. So the third quarter GDP number is going to come out October 28th, I think. Mm-hmm. And that's the official first estimate. And that will get revised twice in the following months, and then it will get revised for years to come. These things are never accurate. They're just estimates. And they will get revised 5 years later, these GDP numbers, they're never static. So anyway, that first number that will come out in October 28th is the one that the Atlanta Fed GDP is trying to estimate in advance. So the Atlanta Fed has a model. It's a computer model, and there's no human decision making really going on there. And so they pick up the data that comes out, and as it comes out for the third quarter, they input that data and they come up with the estimate. So early in the quarter, they start out with relatively little or nothing, and they had this spurt where the GDP estimate was 3.7%. It was huge, and everybody started, the media, went haywire with it. Look, we've got our escape velocity here. We're going to have a great quarter, And the Atlanta Fed is really objective about this stuff, and they pick up the data as it comes in, and the data that has come in. So the Atlanta Fed's GDP number for the third quarter started coming out in early August. So the 3.7% was in early August. Since then, the data has been consistently lousy. Mm-hmm. And it has consistently dragged down that GDP estimate from 3.7 to now, on Friday, it was down to 1.9. So that cut it in half. And that's not what the Atlanta Fed is planning to do or whatever. They're just picking up the data, and the data has been bad. So for the third quarter, 1.9% annualized. Which means that if the economy keeps growing at that rate, it would be 1.9% growth for the entire year. And it's less than 2%. 2% we call that the stall speed. If it drops below that, the United States economy is at risk of falling into a recession. And so it's now at 1.9%. It could drop a lot lower for the third quarter. The first half was even worse. So this year is going to look very weak.
So even if you take that number and you strip out Obamacare, with the high premiums, what is the real GDP? Because health insurance, what does that really add to the economy? Like you said, it adds nothing. So if we strip that out, the GDP is actually much lower, isn't it?
Yeah, and a lot of things would be a lot lower. Corporate revenues and earnings would be a lot lower. Healthcare sector is huge in the United States. It's 18% of GDP. So if you take corporate earnings and strip out the healthcare sector, which has had booming earnings, and revenues, you strip that out. You strip it out of GDP. You strip it out of other things. They've been hiring too. Healthcare is hiring, and you strip it out of the real estate sector. Here in San Francisco, we have entire parts of the town where just one healthcare building after another goes up. And it's the same in Houston. Houston's got a huge office problem, but the office is dedicated to healthcare, doing well. So, this healthcare is in every aspect of the U.S. economy in so many ways, in employment, in real estate, in sales and corporate profits and revenues. It's everywhere. You strip it out. You strip out healthcare down to where, like Germany's healthcare is I don't know, 10% of GDP. If you brought U.S. healthcare down to that level, our GDP would plunge.
And so everything that we've been talking about, where the labor market is not doing as well, we see the auto industry starting to flatten, GDP is continually declining. We're looking at a situation where the economy is not doing well at all. Do you think the economy is already in a recession?
certain aspects of the economy are certainly in a recession. I mean, we know that. I mean, manufacturing is in a recession. We know the transportation is probably in a recession. It could very well be that auto sales are going into a recession. Restaurant sales have recently been bad. So, I mean, that's a recession indicator right there. I'm certain that the U.S. economy would be in a recession without healthcare. I mean, I'm convinced of that. The question is, how long can this? I mean, there's a sad thing to say, because healthcare is really cannibalistic to the economy. It's not the right reason for a growing economy. It's the wrong reason.
Now, out in Europe, we're seeing that they're having problems with many of the banks out there. Italy, Deutsche Bank is one of the big problems. From what you're looking at and what you've seen, is Deutsche Bank in trouble?
Yeah, I mean, that would be the understatement of the year.
Yes, I know.
Right now, the question is how to keep Deutsche Bank from toppling. And that's a big question for Germany, because Deutsche Bank's assets of about $2 trillion are about 58% of Germany's GDP. So it is a huge bank for a country like Germany. And if Deutsche Bank were to topple, it would be a global nightmare. Lehman was tiny compared to Deutsche Bank. And Deutsche Bank.
When you say global nightmare, what do you mean?
Well, the entire financial system would lock up, I think.
Really?
Deutsche Bank is so interwoven in all countries and all banks around the world that if suddenly these banks with assets at Deutsche Bank couldn't do business with Deutsche Bank anymore, and they lost their assets that Deutsche Bank is holding, and they lost. I mean, the transactions wouldn't go through. I mean, you would have a period of time. I mean, like Lehman froze up credit in the United States for a while, and but it would be tiny compared to what Deutsche Bank would do. I mean, you would have nobody would be able to borrow anything for a certain period of time. If that were allowed to happen, you would have credit freeze up in our economy. Credit is lifeblood. I mean, companies borrow money to meet payroll, and GE got in trouble with that in the financial crisis. When credit freezes up, companies can't meet their payroll anymore.
So if credit does freeze up, how would that affect the everyday person? I mean, would they notice anything? Would they just go about their business every day?
Well, they might not get paid. They might not be able to get cash out of their bank. They might not be able to pay for their utilities and mortgages because the banks won't process the transactions. I mean, this is a fiasco. If that happened, there would be a total, absolute fiasco. And that's one of the reasons why I think Deutsche Bank will not be allowed to topple like that, because it would just be such a mess that it would take years to recover from that. Yeah, so everybody knows that, and so Deutsche Bank will not be allowed to topple like Lehman toppled.
Do you think the German government will bail them out?
Yes, they will, and
even though it's against their new, I guess, what is it? Their new laws that they have, where governments can't bail them out, they have to bail them in. You think they will still bail them out?
Yeah, I think what's happening is that Deutsche Bank will find some key investors that will help it. And right now, and I just wrote about that, there's a big movement underway among German industrial companies to prop up Deutsche Bank. So Deutsche Bank might be able to sell them shares and raise some money that way. And then Deutsche Bank might find other investors like the Qatari investment fund that already owns about 10% of Deutsche Bank. And they've lost a ton of money on their investment in Deutsche Bank, so they don't want to lose the rest of it. So then if the government has to step in, it will likely do the same thing, but so buying shares, but it may have to. And when a bank like that raises money via share sales, it actually bails in other shareholders because they're getting diluted. So that is a form of bail-in. So when the German government buys 10 billion euros of Deutsche Bank shares from Deutsche Bank, so Deutsche Bank would issue those shares to the government, that would dilute all existing shareholders. So that would be a form of bail-in. And Deutsche Bank has a number of bonds outstanding that are junior bonds, are called cocoa bonds, and they're designed contingent convertible bonds, and they're designed to be bailed in. And investors know that when they buy them, they carry a pretty hefty coupon. So they pay nice amounts of interest, but when something goes wrong, when the capital levels drop below a certain level, they're designed to disappear and either get force converted into equity, or just disappear. And that takes that liability off of Deutsche Bank's books, and thus creates capital. And so those are probably going to get bailed in when the government steps in, and there will be some other bondholders, junior bondholders, that might get bailed in. So there'll be some limited bail-in, but I'm convinced that they won't bail in depositors, and they won't even uninsured depositors won't get bailed in, and insured depositors won't get bailed in anyway because they have deposit insurance. So I don't think it will go that far, but there's a lot of money there. If you bail in stockholders and if you bail in junior bondholders, you're talking about many billions of dollars. So that could be enough to kick the can down the road for a while. And and that's all they're going to do. They're not really going to fix Deutsche Bank. They're just going to try to kick this thing down the road. The election coming up next year, so ideally, nothing has to be done until after that. Merkel is in trouble already. Bank bailouts are really unpopular in Germany. So hopefully the industrial companies will chip in, and the Qatari investment fund will chip in, and so the government doesn't have to do anything until after the election.
So this is just a Band-Aid fix where they're just going to prop it up for a little bit longer, and they'll worry about it later down the line.
Yeah, and a bank like Deutsche Bank, you need to break it up. And you need to remove the government-insured part from the hedge fund part, and that's not happening in Germany. It's not happening in the U.S. either. That would be a modern version of the Glass-Steagall Act that would do that. But Deutsche Bank has turned in the 90s. Deutsche Bank has turned into a house of speculation. Before, it was a fairly conservatively run bank designed to help the big German industrial enterprises in Germany and overseas fund their operations, process their transactions, do those kind of things. And it served that purpose well. And then in the 90s, it decided to go on this big banking bonanza. It bought Bankers Trust in the United States, which is, by the way, the entity that got fined to $14 billion. It was the U.S. entity, a Bankers Trust entity, that got hit by that fine. So a lot of banks bought financial companies that then cost them a lot of money in the 90s. So now Deutsche Bank has gotten so risky, and it has so many derivatives, and there's so many unknown risks on its balance sheet that it's really impossible for anyone, even in government, to really know what they're looking at. They don't know.
So let's move on to the Fed, the central bankers, and we see Bank of Japan, we see the ECB. They're all in negative interest rates. But here in the United States, the Fed, they raised the interest rates once, and they've been telling us all throughout this whole entire year that they're going to be raising it again, and it just never happened. Do you think it is a possibility by the end of this year that they will actually raise interest rates? Can they raise interest rates?
Yeah, they can, and they probably will. The thing is, the interest rates I always say that, they're going to raise interest rates from almost nothing, by nearly nothing, to next to nothing. So, it doesn't really matter, whether the interest rate is 0.25% or 0.4% or 0.5%. These are not, if economic decisions collapse because you have a tiny uptick of essentially a zero interest rate environment, then you've got bigger problems. I don't think it has any economic impact whether they raise interest rates just one tiny little bit. It has a market impact, and the Fed is really looking at the markets, and it's governed by the markets, and that's what it looks at. So if the markets throw a hissy fit about raising rates, it won't raise rates. If the markets are okay with it, it will raise rates. The bond market in particular, but also the stock market. And the bond market is so much bigger than the stock market, so that's one thing the Fed's looking at. We've already seen some of the long-term bonds get hit by this idea that they're going to raise interest rates a little bit, but it's so minor. The real economy won't be impacted by that.
I mean, you're saying it won't be impacted. So why are they so worried? Because I think in the beginning of the year, they told us they were going to raise it, 2-3 times maybe during this year. And they haven't. I mean, it seems like, they're looking, they tell us they're looking at the different statistics, unemployment and things like that. And we know, really, are they really looking at that to raise interest rates, or are they putting out feelers to see, what Wall Street and what, everyone is doing and how this will affect them? And they put out little feelers to see, okay, we're going to raise interest rates. Let's see what happens. Oh, wait, maybe this is not a good time.
Mm-hmm. Well,
go ahead.
My counterexample is always, what would the Fed do if the labor costs, if wages suddenly jumped by 5% or 6%? What every worker would want, is a 5% or 6% raise. If that actually happened across the economy, you would see the Fed raise interest rates at every meeting until the labor costs stop rising. I mean, they would crank up their interest rates so fast, like you wouldn't believe it. With the one thing that the Fed wants to do is provide corporate America with cheap labor. And they have two ways of doing that. One way is inflation, so wages kind of stagnate and inflation goes up. So actually the cost of labor for corporations goes down. And that's one thing. And the other thing is it wants to just repress wages. And so every time the Fed says they're worried about the job market, I think it's a smokescreen. They're not worried about the job market. They're worried about banks and corporate America. Those are their clients, and they need cheap labor, and they need consumers that can spend money. So the Fed makes cheap money available to consumers to make up for their lack in wages, and that's what the Fed really does. And the rest of it is just, it's just smoke screens. So I think the Fed is interested in raising rates because they see that banks, for example, and some other enterprises are really hurt by low interest rates. A bank makes money on the spread, so between its cost of money and what it can charge, so low interest rates are really troubling for banks. The current earnings reports have shown that banks can make up for that through trading activities and risk-taking and other things, But in terms of the classic banking activities, low interest rate environments are not very good for them. And so, there's reasons for and it wants to have a little bit more leverage more power when the next recession hits. So I think the Fed would feel comfortable with higher rates. And I think they're seriously thinking about it. And if wages go up, I mean, you will see the Fed raise rates so fast like you wouldn't believe.
So what's very interesting is that the Fed continually tells us that, and there was a report that came out that if there is a next economic crisis, which, I mean, we're starting to look like I think we're already in one, but they're saying that, they'll be able to turn on QE once again. I don't think it ever ended, but they'll be able to do more QE up to $4 trillion. And there was other rumors out there from the Fed saying that they might, during the next recession, they might even go to negative interest rates. And they keep putting these feelers out there. And if the economy is doing so well and so fantastic, why in the world would they have to put out those type of feelers or even put out those type of reports?
Yes, great question, great point. The Fed currently is not allowed to buy corporate equities and bonds. So what Yellen actually and that's how far it has gotten. It's no longer underlings that are saying this. It's now Yellen saying this. In one of her speeches, she actually suggested that Congress should give the Fed the power to buy corporate bonds and stocks. And so that the Fed would have that in its toolbox for the next recession. And, the idea is that the Fed can control more and more markets directly. If the Fed can buy corporate stocks, for example, and corporate bonds, if they start going down, it can just print an unlimited amount of money to buy them. And the Bank of Japan is doing that, and so we've seen that in action now. Now, rents are already going down in some parts of the country, including in some of the biggest bubble areas like San Francisco. So when the Fed decides, okay, I can buy corporate bonds, I can buy corporate stocks, and rents are going down, that's going to hurt the big landlord companies. And so why don't I just rent a bunch of apartments? So there's really, once you get down that on that road, there's no end to what the Fed can start buying. Once it asks for permission to, it can buy things, it can rent things. The price of some commodity goes down too far, it can start buying that. Yeah, so at some point, where does it stop? And the Fed obviously thinks it shouldn't stop. I mean, it should have unlimited power to do whatever it wants. And so Congress has put some limits on it, but Yellen is already pushing the envelope. And every Fed governor is doing a lot more than the prior one. So Bernanke outdid Greenspan, and so Yellen's going to outdo Bernanke, and so it's like every governor has to do more rather than less. And I think you're right. I mean, that's the trend that we're on, and I hope Congress doesn't yield, but it might.
So if that does happen, I mean, right now, think about it. The Fed already purchased toxic real estate, so they own a lot of real estate. They're purchasing treasury bonds. Then if they start purchasing equities and corporate debt, really, this is a central bank economy. It's not even the people driving the economy anymore. It's really just the central bank.
Yes, and that's a problem. You have an economy already. It's a problem, because you have an economy that's largely managed. A big part of it is managed by just a few people. The market in many aspects doesn't function anymore. You look at Japan, there is no more market for Japanese government bonds. That market has been strangled. The central bank of Japan is buying every one of them out there, and so there's nobody else buying these bonds. They're all selling, and they're selling to the central bank. So that they have killed that market. They're now a heavyweight in the stock market. When they get any heavier, pretty soon, that the market will do the same. The stock market will do the same thing as the bond market did, which is just become a one-way street from those that hold these securities to the central bank. That's not a market. That's not a buying and selling. So if that happens in the United States, it will further eliminate the functioning of the markets, and part of it is already not functioning anymore.
So how much further do you think they can take this? I mean, what are we looking at here? I mean, we have elections coming up very soon. We see there's some type of crisis in the Middle East with Russia, and the U.S. already made an announcement that they're going to wage cyber war with Russia. And we're looking at, everything coming together all at once. What happens next? I mean, does the economy collapse? Does the Fed, gain more power to save the economy? Where do you think this is all going?
Well, it may be wishful thinking, but I hope the economy will not collapse. I don't like that idea at all. The Fed will continue its efforts to gain more power. It has always done that, and it will continue to do that. After the financial crisis, it gained more power in regulating the banks, for example. I mean, the financial crisis happened because the Fed didn't regulate the banks properly. And so now, it has even more power regarding the banks than it had before. This is the pattern, So somehow the Fed keeps getting more power. Yeah, and if you get another financial crisis, another major economic issue here, very likely Congress is going to give even more power to the Fed and to somehow save the situation, and thereby making it even worse.
Will that improve the economy, or will it do absolutely nothing for the economy?
The economy needs a real good cleansing, and it needs the free market forces to work their way through it, and that's not been allowed since the financial crisis. So anytime the Fed is trying to turn things their way, it's just going to long-term make it worse.
Wolf, I really appreciate you being on the X22 Report Spotlight. Once again, how can people see your work?
wolfstreet.com. Everything I do and what my contributors are doing is on there. It's all free.
Fantastic. Thank you very much for being on the Spotlight once again. Thank you very much.
Well, thank you, Dave.